This is Las Vegas Real Estate Now with local real estate expert Harvey Blankfeld.
Where we want to educate you about our market, empower you to make wise decisions, and help you engage with our expert contributors. There's a lot of refis going on right now. There's a lot of mortgage activity. Tell us about that, because I know you told me the other day a stat that I was shocked to hear.
Yeah, there is a stat floating around that basically says this. The mortgage industry right now is built for about $1 trillion of mortgages to be done. That's how much, staffing and systems and all that kind of thing. We were, at the beginning of 2020, we were prepared for $1 trillion of mortgages to be done. Now, in this world, today, there's $3 trillion of mortgages trying to be done today. And you can imagine that is overwhelming to the mortgage lenders that are in the space. And there is, we're all effectively running as fast and as hard as we can, trying to deliver a great service and treat our clients well. But it's everything we can do to hold on to this thing right now.
Wow, yeah, that's a crazy amount of business. And so, one of the things that I said the other day, and I say it's kind of tongue in cheek, but they don't really need our business. They don't really need our business right now.
Some of the big boys have certainly made that decision. I know of some of the major banks out there, and I can't drop a name, but some of them, they actually have moved their rates higher to slow down their volume. It's interesting. You can go to some of their websites. You look at their interest rate on a purchase loan, it's one thing, and you look at it on a refinance, and it's up here. It's higher.
Wow.
And they're doing that deliberately to try to control the volume that's trying to go through their system. They have as much business as they can handle. And if I take in, I'm just using a silly example here. If I take in one more loan, all I'm going to do is piss you off. So maybe I shouldn't have that loan this time, and they don't.
So it comes down to the simple basic laws of supply and demand.
Yeah.
There's just so much demand right
There's
now.
only so much I can ask of, of the team and how many hours they can work to try to do the job. And, I guess I'm pleading for sympathy as the mortgage industry here, saying, please give us a little grace, a little understanding that we're trying to do our best. We want these interest rates for everybody. We want to, save you a ton of money. It's just a lot of work.
All right, well, let's do the weekly update now. Let's get to that.
All right.
And let me show you're not going to be able to see this right away, John, but let me show our listener and pay close attention to how I describe
I'm going to act like a radio listener.
Yeah, pretend
right
like you're listening to me this time.
I'll pretend.
Okay. This week we had, again, this is all just single family homes in the past 7 days. And currently, as of today, we have 5,182 single-family homes in the market. That's down again 11, only 11 from last week, but still down. We've seen that number go down consistently over the last 2 months. In escrow this past 7 days, we put 841 homes in escrow. We closed 745. That's up 50 from last week. 158 homes were withdrawn. Again, isn't nothing surprising or nothing unusual there. The median sold price went to $325. That's down a little over $5,000 from last week. But once again, the thing about the weekly data points is there's just not enough big enough sample size to really give an accurate
that
assessment.
One you can't give it much weighting other than looking at it on maybe a monthly basis.
Exactly.
A week by week doesn't tell
It's
you a
tough.
ton.
But we can follow it over time and see a trend at least, and that's the thing.
Sure.
And here's the more interesting stat: the median sold price per square foot was $176.06, which is virtually the same as last week. So that didn't change much at all. What does that tell us? That tells me that the product mix was just a little bit different this past 7 days than it was the previous 7 days, but the overall price remained fairly much the same in terms of price per square foot, which is an interesting stat to follow. Now, the other thing is that median days on market went to 42, and this keeps creeping up. It was down as low as 30, 35, I think it's at one point, and it keeps creeping up the last few weeks. What does that mean? Here's what that means, guys. There's a lot of inventory out there that's just overpriced and just sitting there. A lot of homes come to market and sell. I can tell you from personal experience, this past 7 days, I took several listings and 2 of them had offers within a day. And so if they're priced right, they're selling fast because buyers are looking for properties. And with a smaller inventory, if you price it right, you're going to sell it fast. But if you're overpriced and you remain overpriced, you're just going to sit there. They're not going to get you. So that's what that tells me.
And that clock has nothing to do with I went into contract and the financing took longer to get. That's purely I put my house on the market and this many days go by before I go into contract to sell it.
Yep.
Okay.
That's exactly right.
Okay.
Okay, so let's take a look at the trends. I'm going to pull up the trend we've had. This is the stats going back, and this goes all. I did these all the way back to late March. And here I took those numbers that we plugged in this week, and I plugged them into here and into this grid. And what we see here is, again, what I just told you was the inventory is consistently shrunk. Go back to May 21st, it was 6,400 and change, and it's gone down every single week from there, and now we're down to 51 and change. So a dramatic, 20% reduction in inventory, pretty significant reduction in inventory. Now, the other thing that's interesting to note in here is the number of homes being put in escrow has been pretty consistent in the 800s for the last 5-6 weeks, and it was before that it was in 900. And the number of closings has consistently gone up over the last 4 weeks. So what we're seeing is that the market is vibrant. It's not like it normally is this time of year, though. I will tell you, in terms of the amount of volume we're doing, the number of homes we're selling, it's not like it would have been had we not had the pandemic.
Oh, sure. It's
just not like that. It's not a completely normal market, but it is behaving very, very well. And as a realtor, I'm very pleased to see that. First of all, prices are not only holding, they're steady and strong, and in some places they're going up. In some markets they're going up.
Anecdotally, I can say from the mortgage side of the business, we've seen a tremendous a strong uptick in the amount of purchase transactions as we've come out of or come through the reopening. There was a moment there where 80% of the transactions coming in the door for us were refinances, and now that has flip-flopped back to something in the neighborhood of 50%, 50-50 now is purchase and refinance.
Wow.
With as much refinance business that is happening, that actually says a lot for purchases.
Interesting article. This was just yesterday by Richard Vallada in the RJ, and he was quoting Jeremy Aguero, who's an analyst here for Applied Analytics. That he's the go-to guy for Southern Nevada economics and housing and all that kind of data. And he interviewed him, and Jeremy actually did a presentation last week. And what Jeremy is saying is that he believes it's going to take anywhere from 18 to 36 months for us to recover from the economic impact of this pandemic. What do you think about that kind of a prediction, John?
It doesn't sound far off to me. I think it's in a reasonable time frame. I think that we do have, in my opinion now, we do have a bit more pain ahead of us. I think with the reduced volume going through the Strip, all those casino employees that are going to be laid off, receiving less hours, less income, they're going to be negatively impacted. All the ancillary services that plug into that are going to be negatively impacted. And so as we get through or past the stimulus and these temporary supports that we've put into the economy, some of this stuff is going to come home to roost. I will go one step further, which is to say, I think those people out there watching for like a real estate dip or crash of any type, I think you may be waiting a very long time.
I couldn't agree more. I just, like Mark Stark always said, the metrics just aren't there.
Correct.
They're just not there. He goes on to say during the Great Recession, let me bring this back up for everybody. During the Great Recession, we lost over 196,000 jobs were lost over 2.5 years. In the pandemic, we lost 280,000 jobs in 2 months. 2 months. So, I mean, it's just a different kind of animal. He went on to talk about 3 types of consumers going forward, which I think is an interesting way to categorize. He said, okay, so here they are. 3 types of consumers. The first one says, we're all overreacting, let me out now. The second one says, I'm going to come out when Dr. Fauci says it's okay.
Okay.
And the third one says, I'm never coming out because I don't trust anybody anymore. Basically, he says, and so that's going to affect how many of each category is going to affect how quickly we come out of it, and how well we survive throughout this. Please join us again next week as we keep you up to date on everything real estate here in Southern Nevada. Remember, send me any questions or ideas for next week's broadcast. Tune in every Thursday at 3. Also, please let your friends and family know to like our Facebook page and be reminded about our updates at LV Real Estate Radio. We'll catch you next week. Thanks again for joining us.